Welcome to our coverage of the Fed's FOMC meeting and their policy decision. And this time they actually did something, so that was quite exciting. And it was a 50 basis point cut, 0.5%, as many people expected. In fact, as markets expected. In fact, the Fed never seems to do anything except what the market expects. So it was quite boring from that point of view. But I think what the interest about this policy meeting is whether the Fed was behind the curve. And there were various questions about that, which we'll deal with in a moment. But the picture that we see overall is one of a soft landing. So it's still the case, I think, that that's the situation that we see. And the Fed is still doing its victory lap because that's what seems to be happening. So let's just go quickly through what was said, and then we'll talk about the update of the dot plots, because that's really important. It's called the Summary of Economic Projections. That gives a really nice insight into the Federal Open Markets Committee's views about where the economy's headed and also their policy. And I think we'll also talk about maybe a bit at the end about market reaction, and of course I'll lay it open to questions. And if you are one of our supporters on YouTube or you do a super chat, we'll push you to the front of the queue for those questions. And of course, don't forget we've got the Bank of England tomorrow. So that's something to look forward to. Yeah. In fact, someone has already made a comment. Purple tie, never lie. There we go. If you look at the colour of his tie, it's supposed to give you a hint about what the policy rate's going to be. So that's obviously his dovish tie. So let's start with the statement. So this is what comes out just before the meeting. And you can see I've highlighted what I think are the important points. Job gains have slowed rather than moderated, which I think is a stronger phrase. The committee's gained greater confidence that inflation is moving sustainably towards a 2% rate, so that's important. Previously, they weren't confident. Now they are, hence the policy decision. And what was also interesting is there was a dissent. Now, what usually happens, what seems to happen, is that the committee debates stuff, they look at the data, they have an exchange of views, presumably, and then they come up with a consensus decision where there are very few people that dissent. So it seems as if that's what happened this time, except one of the governors, Michelle Bowman, actually said that she'd prefer to only decrease by 0.25%, which is the normal rate cut. So instead of the jumbo cut of 0.5%, she wanted 0.25. So that's unusual. We haven't seen a dissent for some time. So potentially there could be dissent further down the line. Now, many people noticed at the previous meeting that the SARM rule had triggered. If you look at the pickup in US unemployment and you kind of munge the data, this is created by Claudia Sarm, it's been a very good indicator of US recession. If unemployment picks up, you're in recession. Well, it's picked up, it's crossed the threshold that historically triggered a recession. But if we look at all the other data, it doesn't seem as if the US is in a recession. And that's one of the things that Powell stressed through the whole meeting. There is no hard sign of a recession in the US. Many other indicators are quite positive. But clearly, yes, the unemployment rate is ticking up from a very low level. And that's certainly influenced their decision. Now, it's interesting because if you do signal a big cut, if you do have a big cut, it kind of hints that there's some kind of crisis in the economy. So, as Nick Timiraos says, he's the Wall Street Journal economist, also author of the brilliant book called $1 Trillion Triage, which talks about what the Fed did through the entire crisis period around the pandemic. It was incredible what they achieved and the level of stress in markets which they managed to quash. But brilliant book. Anyway, he always asks good questions. And here he's tweeting about why the Fed was trying to paint this 50 basis point cut in non-scary terms. They said, we're committed to maintaining our economy's strength, i.e. it's strong and we're going to keep it strong. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labour market can be maintained. So yes, it's weakening a bit, but we'll keep it, strong relative to history, which is true. Unemployment is low relative to history. If you compare the unemployment rate right now, is roughly where it was in 2000, and then previously you've got to go all the way back to the 70s to get such a low unemployment rate in the US. So you can kind of think of this, I think, as a kind of cross between a John Wayne moment and although it does look a little bit like Breaking Bad. This is AI generated, as you can probably tell, but it does seem as if they're still doing a kind of John Wayne type of inflation being shot up at the OK Corral. And yes, we've managed to get a soft landing, everything's fine, and it did seem a little bit like a swaggery victory lap. So now let's turn to the summary of economic projections, because that's kind of important because it tells us what the Fed is thinking. And this is the latest update. They don't update it at every meeting, but they certainly updated it this time. And the one which I think is interesting, and the one which certainly bond markets didn't like, is if you look at the policy rate, they give it over various horizons. So they say, we think that the Fed funds rate is going to be, by the end of 2024, it's going to be 4.4. So implicitly, that means we're going to get 2 more 0.25% cuts, because we've only got 2 more meetings to go. And the other one that was interesting that markets didn't like, fixed income markets, is the longer run rate was increased. So whatever the kind of neutral rate is, think of that as the kind of the rate at which the Fed funds rate, which doesn't increase inflation or decrease it. So think of that as a kind of neutral rate. That seems to have been increased slightly. Now that means that their end point is going to be higher, and that made fixed income markets sell off. Higher yield means lower prices. So certainly the long end of the US Treasury curve fell. Well, the yield curve moved up and the prices of the bonds fell. So markets didn't like that. But in terms of market expectations, this is what markets expected. GDP numbers, not much change from the June projection. The other relevant thing is if you look at the unemployment rate projection compared to June, for the end of 2024, they now expect 4.4%. So 0.4 percentage points higher is very significant and obviously not good. So that probably factored in their decision making. So in red here, you can see what the policy rate expectations were. So these are all the individual dots. Each of these dots is one of the FOMC committee members' expectations about rates in 2024, 25, 26, 27, and over the longer run. And you can see the changes over that period. So 4.4 for the end of this year, so lower. 3.4 for 2025, so lower. And then 2.9 for 2026, lower. And then 2027 was new. We didn't have that last time. And as I say, the longer run, higher. So that was kind of interesting. But overall, no huge surprises here, I don't think. But the 0.25% cut is what I expected, because I thought, well, there's not a crisis. So if they have a 0.5% cut, it looks like a crisis. And the data weren't that bad. But presumably they're trying to get ahead of the curve here. And we'll go through some of his comments which kind of back that up. So if we do look at the expectations, this is what was backed out of the Fed funds futures market. Every morning before these Fed meetings, and I've done this now for several years, I look at this FedWatch tool from the Chicago Mercantile Exchange, and that backs out the probabilities of rate cuts according to market expectations. So in July, this is what it looked at. Now don't look at the detail here. There are lots of cuts after September. So today, there's a rate cut every meeting except for one. But now we're going to switch to how it looked this morning. So that was last time. This is what it looked like today. And you can see the difference is huge. Let me just switch back and forth. Notice how, as we go through the meetings, firstly, the axis is massively extended now. previously it only went to 300 to 325 basis points. Now it goes all the way down to 175 basis points. So much deeper cuts and more rapid cuts is what the market's expecting, because perhaps of that weakening of the labour market. Also, markets did expect the 50 basis point cut today, but after a normal cut at the next meeting in November, they're expecting another 50 basis point cut in December. So we'll talk about the cadence and the size of the cuts as well, because Powell certainly talked about that today in response to questions. So markets now are expecting very aggressive cuts, more aggressive than the Fed is suggesting. So the Fed is saying that the dot plot suggests that we're going to get 2 cuts of 0.25%. So that's either 1.5% cut or 2.25% cuts towards the end of this year. But you can see that markets are seeing something a little bit more aggressive than that, 0.75, 0.75, so 0.25, yep, so 0.75 even from here. So I think that's a little bit too aggressive. Now the balance sheet, yes, we're going to carry on seeing runoff of the balance sheet. Currently it's down by about 21%. So it was at 9 trillion, now it's about 7 trillion, just over, and that runoff will continue. There was a question about reserves, and certainly the Fed at the moment doesn't think there's a problem with the lack of reserves. There was a problem with the repo market, if you remember previously, when reserves dried up, but certainly at the moment the Fed doesn't think that's a problem. So now let's turn to the press conference and some of the things which Powell said, which I think are interesting. And I'll just switch to me talking here and move my notes over. So firstly, it was all about catch up, right? So if you look at the Twitter feed, the X feed, I don't know what you call it now, about the meeting, a lot of people are talking about whether the Fed was behind the curve and whether the 0.5% cut was because they didn't cut by 0.25 in July. This was a catch up. So the way the Fed span it is as patience. They're very patient compared to other central banks. So, for example, Nick Timmerhouse asked a great question. He said, does today's action constitute a catch-up in action given recent substantial revisions to the unemployment data? Or is this larger than typical rate cut a function of elevated nominal level of the policy rate, such that there's an accelerated cadence, in other words, bigger jumbo cuts and more of those jumbo cuts can be expected to continue? Powell said, so I would say we don't think we're behind. We do not think. We think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. And then there was a later question by Colby Smith, which picked up this catch-up theme again. And he said, the time to support the labour market is when it's strong, not when you begin to see the layoffs. So that's the situation we're in. We have in fact begun the cutting cycle now, and we'll be watching, and that'll be one of the factors we consider. So you cut the rate when the labour market is strong. You don't wait until there are lots of layoffs. So he's saying unemployment is still low, but we're getting ahead of the curve, if anything. So again and again, he used the word patience. So he said, our patient approach over the past year has paid dividends. Inflation is now much closer to our objective. We've gained greater confidence that inflation is moving sustainably to 2%. So a lot about this patience. There's nothing in the SEP that suggests the committee is in a rush to get this done. This is a process that evolves over time. And then we've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that's what enables us to take this strong move today. So he kind of turns it around and says, because we were patient, we could take a bigger rate cut today and be more confident that we're doing the right thing. And I think that's a reasonable justification. They had to be sure. You know, they are data driven, and they have to be absolutely sure that what they're seeing isn't just noise. if there's just one print which suggests that inflation's lower, that wouldn't be enough. You have to see the trend, and presumably that's why they didn't act in July. But he did say that I do not think that anyone should look at this and say, oh, this is the new pace. We have to think about it in terms of the base case, blah, blah, blah. And that's, if you look at the SEP, all we're seeing is 2.25% cuts or 1.5% and then no cut towards the end of this year. 2 more meetings to go. What is clear is that the balance of risks have changed. Previously, it was all about inflation, and unemployment wasn't so much of a worry because it was very low. Now that unemployment is starting to tick upwards, the balance of risks is kind of even, and he said that repeatedly. So a risk of inflation flaring up again, but also a risk of a weaker economy and higher unemployment. But it was, and he did stress as well, if you look at the SEP, all of the participants wrote down multiple cuts this year, all 19 of the participants. So if you look at the dot plots, that's true. So really, there was dissent, but everyone thinks there are going to be cuts between now and the end of the year, all of the committee members. The reserves stable, and there was an interesting question about the dashboard. These are the things that the Fed looks at to see the state of the economy, and of course there are hundreds of variables, but the key one is unemployment. So he said probably you're at 4.2%. That's higher than we were. We were used to seeing numbers in the mid and even below the mid threes last year. But if you look back over the sweep of the years, that's a low. That's a very healthy unemployment rate. And anything in the low fours is really a good labour market. So that was positive. Participation's at high levels. And if you adjust for demographics, for ageing, participation being high is a good thing. Wages still above their rate that you'd expect to be consistent with a 2% rate of inflation, but coming down to what that sustainable level is. So that's good as well. Vacancies per unemployed was 2, so there were 2 job vacancies for every unemployed person, but that's come down to 1, which is still above where it was before the pandemic, but coming back to more reasonable levels. So that's good. That's not inflationary. And if you look at job quits, that's come back down to normal levels. So that's also a sign that the labour market's cooling off. Less people are quitting, so they feel less confident about finding a new job, presumably, which suggests that it's not such a tight labour market. So overall, he summarised it as follows. He said, this is still a solid labour market, and the change over the last few months has been positive, and the upside risks to inflation have come down, and as that's happened, the downside risks to unemployment have increased. And because we've been patient, there's that word again, and held our fire on cutting, while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals. So it's all thanks to patience. Politics. Every time we have a question about politics and whether the Fed should be independent, and of course President Trump is very keen, ex-President Trump is very keen for the Fed to keep rates low. And so he said, how do you respond to the criticism, one of the questions, that you're likely, that the deeper rate cut now before the election has some political motivations? And Powell just shot that down. He says, this is my 4th presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking, what's the right thing to do for the people we serve? And we do that. Our job is to support the American economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So we don't put up any other filters. If you do that, if you start doing that, I don't know where you stop. So we just don't do that. So clearly politics does not enter the committee room when they make their decision. It's about the economics, and they're not going to favour any political party, at least not explicitly. It's never discussed. And there was an explicit question about why it's good to have an independent central bank, because we've seen countries like Turkey where the president has some crazy theory about if you increase interest rates, if you decrease interest rates, it actually creates inflation. So if you increase interest rates, it increases inflation. So the Turkish president got it exactly the wrong way around, and for a long time that kind of fueled the fire in Turkey of inflation, and it had incredibly high rates. If you compare that with countries with independent central banks, they're not going to just do something to please the populace and to push up stock prices. They're going to do what's right to keep inflation grounded. So Powell's answer was a good one. He said, countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. The reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favours people who are in office as opposed to people who are not in office. So if you're allowed as a prime minister or as a president to affect monetary policy, you'll do it in a way to just stay in power. So that's not what you want. You want what's best for the economy. And he said, we do our work to serve all Americans. And if you look at countries that have independent central banks, they get lower inflation. We're not serving any politician, any political figure, any cause, any issue, nothing. So I think that was pretty clear. And I kind of agree. You don't really want to become like Turkey with President Trump, if he gets into power, dictating monetary policy. That would be a huge mistake, I think. And it would show that the democratic principles that America runs under and the norms that we get, which keep things stable, would be eroding. And I don't think markets would take that at all well if the central bank stopped being independent. So let me stop there, and we'll get Teddy to come upstairs, and I'll turn it over to you for some questions. So I'm going to rattle my treat box. Teddy! Ted! Here he comes. Teddy! Look what we've got. Look what we've got. We've got treats. Yes, so do think of a question. And I'll give him one of the good treats today. Because he's come all the way up the stairs. Now he's just looking out of the door because he wants biltong. You can have a good treat. Oh, he's dropped the treat on the floor. You don't want it. Teddy. Okay, you can have a good one then. You've got to do your trick though. You've got to stand. You've got to stand. You've got to stand. Stand. Oh, good boy. You clever sausage. There we go. That was the dog tricks. Yeah, so if you have a question, just pop it into the chat and we'll answer it. If you're a supporter of us on YouTube, we'll push it to the front of the queue. If you do a super chat also, we'll push it to the front of the queue. And of course, we appreciate it if you do the super chats, because obviously it helps us financially. You're going to go down for the biltong now. You go downstairs for the biltong. Go, go, go. Go, go, go. Go to Laura. Go on. Oh, right, leave now. Did he eat it? Yeah, you finally ate the other treat. You're not going to say no to a treat. Go on, you can have one more. Oh no, biltong. Yeah, he's off. Okay, so if you have a question, please ask and we will answer. Investment questions, clearly. Okay. Festerari says, I like the 0.5% cut. It's right given employment figures Bank of England will cut 0.25% though, I think. Yeah, markets are expecting for the Bank of England, the probability of a cut for tomorrow for the Bank of England, according to markets, is about a third. The probability of 2/3 is for them to do nothing. So the default is for the UK to do nothing. Because remember, in the UK, inflation, certainly services inflation, is remaining quite sticky. And it's taking a long time for that to come down. Headline inflation has come down, it's at 2.2%. But of course, that's driven down by energy prices. Whereas if you strip those out, food and energy and tobacco, then inflation, services inflation, is looking quite high in the UK. So that's not good news. Spherical Hang says evening. El Sabio says hi. And okay, Michael Williams says the VIX jumped quite a bit after this disaster of a rate cut. I'm not sure why it's a disaster. MCS says 50 bips is a panic reaction. This won't take effect for another year. So they see a potential recession now. Well, if you listen to what Powell said, he says the time to cut is when the jobs market is still strong. Unemployment is still low. And it is, factually. If you just look at the rate right now, I think it's 4.4%. That's still pretty low by historic standards. And if there was a recession, there'd be all sorts of other indicators that indicate things are getting worse. So I didn't show it, but actually let's have a look at it now, which is the rate of GDP in the US right now. So this is the GDP rate, and this is the quarterly change, but annualized. So the latest one was 3%. And yeah, so pretty strong. If you look at these recent numbers, there's not a huge sign that it's gone down a lot. The previous print was a bit low, 1.4, but before that it was 3.4, 4.9. So that kind of looks like the kind of GDP quarterly figures that we saw before the pandemic. So I'm not convinced that we're seeing a weakening here. Certainly not in the data I can see. Yeah, and then if we look at the payrolls, if we look at the employment data, you can see that, okay, last two prints were pretty weak, 89 and 142, but still not in negative territory, which is kind of what you'd expect if there was a recession. So certainly a weakening of demand is what we can see, but a full-on, full-blown recession is not what we see, I don't think. Certainly not in the data which I look at. What else have we got? Okay. Concon MCMC says, hi Romin, has Andrew Bailey got back to you explaining why he's selling bonds at a loss? Strangely not. Strangely not. Although it might actually help the Labour government in terms of if they include the losses from the Bank of England's balance sheet, it could actually mean that they can issue more debt, so they could actually stimulate the economy more by spending more. So maybe indirectly these losses are a good thing. Nick says the narrative earlier this year was that Fed cuts would help drive S&P growth as the rate at which future cash flows are discounted would support higher market caps. Is this still the case? I think you've got to look at valuations, and currently tech stocks in the US are priced to perfection. They're assuming everything's fine, and furthermore they're still reacting as if the cost of funding is going to stay low forever. In fact, those mega cap tech stocks generally don't depend on debt. If you look at their capital structure, they have such strong revenue and revenue growth that they don't depend on debt in order to fund their daily operations. There's not a lot of leverage on their balance sheets. So the cost of funding for the mega caps certainly is not really relevant. It's not a big driver of their P&L. For companies which are more leveraged, and those tends to be the smaller companies, mid caps and small caps, leverage is much more of an issue. So if interest rates increase, it's much more of a drag on them. So what I'd expect is that small caps will actually do pretty well out of these rate cuts. Maybe not the mega caps, because for them the cost of funding is not so important. So I'd expect small caps to rally. And I've had a small cap position in the US for some time because of the huge gap in valuation between small caps, the S&P 600, and large caps, the S&P 500. So those are the stocks which I think will benefit. And all the obvious ones like real estate will do well out of this because that's the sector that got really hammered by higher interest rates. And the financials, banks, which were so unsexy until recently, they'll probably benefit from lower interest rates as well. So those are the places I'd expect to see a big tick upwards as a result of this. Apple Pie 1 says hiring rates are slow. Yep, hiring has slowed down, but of course that's by design. They're trying to get the economy to slow down, to reduce demand by having a more restrictive monetary policy. And that worked. We had not a huge pickup in unemployment, but we had a loosening of the labour market, which is what they were trying to do. So they've achieved the soft landing, I think. That's certainly the way the data looks. Do you think this makes the Bank of England, Andy McNeish says, do you think this makes the Bank of England more likely to cut faster? I don't think so. I think every central bank's got to do its own thing. One point which I thought was interesting, and the FT was reading this today, is if the Fed cuts then and the Bank of England doesn't, then that would tend to strengthen sterling. Now remember, if you strengthen sterling, that can cause inflation potentially, because if the cost of it could be that if the UK gets behind the curve when it comes to cuts, then it could strengthen its currency, and that would mean that if you look at the value of goods which the UK is exporting, they look more expensive in terms of, if you're buying UK goods and you're in the US, they look more expensive if sterling is stronger. So yeah, if the Fed cuts and the Bank of England doesn't, there could be this kind of mismatch which could weaken UK exports. But certainly what's hurt my portfolio recently has been a stronger sterling. So I hope the Bank of England cuts, because that would tend to weaken sterling and it'll favour my US heavy global index funds. But I think, you do have to think a kind of second order effect is about pass-through inflation, and but certainly at the moment I don't think the Bank of England is going to be thinking about that. They'll be thinking much more about sticky services inflation rather than the currency effects of being out of sync with the Fed. They're still not that out of sync if you look at the policy rates. But if there was, 2 percentage point or 3 percentage point difference, that would be a big deal. But I don't think it's likely to make the Bank of England cut faster. David Pringer says, how can it go from hysterically high employment to hysterically low employment in 3 weeks? I don't think that's what was said, but if you look at the employment data in the US right now, let's pull it up. And I think I started with that actually. So this is the actual SARM rule, and so the top panel is a SARM rule which looks at changes in unemployment over so it takes the average minus the minimum of the average over the last 12 months. So it takes a 3-month average to smooth the data, and then it subtracts the minimum of that 3-month average over the last 12 months, and it looks at the change over that period. And if it's picking up rapidly, the smooth data, that usually triggers. That's usually a sign that we're already in a recession in the US. Interestingly, it doesn't work for the UK. I tried creating a SARM rule for the UK and it just doesn't work. But for the US, it works very well. So unemployment at the moment, it's increasing, but it's still around 4%, 4.3 I think was the latest data. Let's have a quick look. Let's have a look on Fred. Unrate is the ticker. Here we go. Make my face smaller. There we go. Yeah. So unemployment rate right now is 4.2. So still not very high. You know, it's higher than it was. The low point was about 3.4. I think was the lowest it reached. Maybe 3.3, 3.5. And you've got to go back a long way to see such low rates. You have to go all the way back to 1968, the year I was born. So the month I was born, the unemployment rate was 3.4. And we're not hugely above that right now. So I don't really buy the statement that unemployment is really high now. I don't think it is. By historic standards, that's certainly not true. So yeah, soft landing. There we go. Oh, and ConCon MCMC did a super chat just to say thank you. Thank you very much, ConCon MCMC. Is that Markov chain Monte Carlo? I don't know. I hope so. And he also says thanks for these videos. Appreciate it. Thank you very much. And back to your questions. Doesn't history show that after a rate cut, especially after a 50, the markets plummet a short while after? It really depends on the circumstances. So, you know, why are they cutting aggressively? One reason would be that we've just had a huge crisis, a pandemic, global financial crisis. And in those kind of situations, an aggressive cut signals that the Fed is desperately trying to stave off a recession. This is very different. This is a cut in which we've gone from a very tight labour market to a slightly less tight labour market, a looser labour market. We've got gradual fall in demand for workers. Demand and supply of workers is getting back into balance. Inflation's falling. It's getting back towards the Fed's 2% target. So this is an economy that's mending, not an economy that's just gone through a huge shock where the Fed is desperately trying to cut rates to zero to fix things. No, this is a kind of slow healing process, which is about patience, as the Fed chair was saying. So I don't think this is signaling that we're going to have a huge sell-off in markets, because there's no crisis. There's no huge cooling of the economy. Unemployment's not rising massively. So I'm not seeing reasons why there should be a big sell-off. We are going through a period of macro transition from a period of very restrictive rates to less restrictive rates. But that's good for the equity market, particularly small caps. And I think this could be a resurgence of small caps. This could be a catalyst for that. We have seen signs of that earlier, but it kind of fizzled out. But I think certainly for the first few rate cuts, and this jumbo one in particular, that'll probably be good for small caps and certainly for the real estate sector and for the banks which have lent money to the real estate sector, which were really beaten up for a long time. So I think it'll be good for those parts of the economy. Hedge Fund says, smash the like button. Please do. That would help us a lot if you do that. Thank you. And what else do we have? No more super chats. Oh dear, that's not very good tonight, is it? Let me just mention while we're here the podcast, which is free. Many happy returns, which Michael and I, my podcast co-host, Michael Pugh, who's the brains behind the whole operation and the beauty behind the operation as well. Podcast. He's the young clever one. I'm the old clapped out guy who just rambles. But this is the latest podcast that we've published, and it's smart ways to stash your cash. Because a lot of people, I think, are worried at the moment, and they ask me repeatedly about how can you invest in safe things? You know, where can I put my money such that it doesn't lose value? So we're talking about how you can stash your cash, what's safe, what's not, and that's what we were talking about this week. So please do listen to that on YouTube if you possibly could. So many happy returns YouTube, because we put it onto YouTube recently. And if you want to subscribe to that, if you want to just get notifications, you can do that. Just go to youtube.com and yeah, let's go back. Yeah, youtube.com, and let's watch one of these on here.
Today's episode is sponsored by...
I just wanted to get the URL. Yeah, here we go. So the URL is youtube.com/@manyhappyreturnspodcast. So it's youtube.com/@manyhappyreturnspodcast. So do subscribe, because obviously it helps us, the stats help us, and you can listen to it on YouTube, and it'll encourage us to publish a video that goes with each one. I think that would be quite cool if we did that. Michael's not so keen, so maybe we can encourage him to kind of record videos that go with it. That would be lots of fun. Yeah, so anyway, Many Happy Returns podcast about stashing your cash. I think you may find that interesting, particularly if you do think things are getting worse and we're going to have a bit of a sell-off. Knowing what's safe, I think, is really valuable, and seeing what held up in the past, also very valuable. Your questions, and we'll give it a few more questions and then we'll finish, because it's 9:30 and I've got to do this again tomorrow. So one more question and we're done. Previous Fed, okay, here we go. I have a mortgage deal coming to a close on October the 31st. Would it be wise to wait after then for further rate cuts and go on to the bank's SMR for a short time? I'm looking to lock in a fixed rate over 5 years. It's funny you should say that, Ben, because Michael and I were talking before the podcast, we recorded it, about how people are kind of ambivalent. They kind of know they can't forecast the yield curve, but when it comes to mortgage rates, which are based on the yield curve, suddenly everyone's a confident forecaster. They're all saying, oh yeah, you should wait until you fix your mortgage. Clearly the direction's downwards overall, but it's taking a very long time to come down. And one of the graphs I'll use tomorrow for the UK shows the mortgage rates, so we'll have a look at that. But I don't think it's possible to forecast which way it's going to go. Probably it's best to delay, because I think the rates will be lower later on towards the end of this year and into next. Probably I'd wait if it was my choice, if you can wait. But look, you can always remortgage your house. There is a cost, of course, there is a penalty to do that. But personally, I think if you can delay, I probably would. And I'd probably do it for some time, 6 months. Because the Bank of England is cutting very slowly because of this sticky services inflation. And who knows, maybe towards the end of this year, there's going to be another energy crisis as demand for gas increases and competition for liquefied natural gas increases. The supply squeeze from Russia now is less of an issue. Europe's got better alternative supplies. We're getting more imports from the US, for example. But there could still be a squeeze which could push up inflation, particularly for the UK, which is so energy dependent on things like liquefied natural gas. So I think we could see another inflation spike, is what I'm saying. And of course that would halt the rate cuts and it would affect mortgage rates. So that's the kind of chain of logic which you should be aware of, and certainly thinking about when it comes to deciding whether to fix your mortgage or not. It could be that rates actually go up. That could happen in the UK. In the US, less so, I think, the chance of that, because they are more energy independent than we are. They've invested in shale oil, for example, whereas we don't have a kind of coherent energy policy. And yeah, I think if we were more energy independent, it would certainly be good for the UK economy. So yeah, thank you all for listening and taking part and asking questions. We appreciate it. We'll be back again tomorrow. And obviously tune in for that, because a lot of our audience are from the UK. We even have some Americans watching about what the Bank of England does, which I always think is interesting. I always assume the Americans wouldn't care what the Bank of England does, but apparently some people do. But do join us tomorrow night, and please do like and subscribe. Subscribe to our podcast. Go to youtube.com/@manyhappyreturnspodcast and click on subscribe. We'd appreciate that. And speak again tomorrow.